There's four at least main reasons or main factors behind gold's current appreciation. One is the relative weakness in the U.S. dollar, which has to do with the relative increase in U.S. debt and the fact that central banks around the world have for multiple years decided, led by China, but by Russia, by India, by Saudi Arabia, basically not to buy U.S. treasuries and instead to purchase gold into their reserves. And that's one of the reasons why we have had 4 record years of gold purchases by central banks. We're in the fourth now. And we've also seen that the percentage of central bank reserves, money in their system to basically solidify their own financial systems, which is what those reserves do. And they also supply relationships and trade relationships between banks and financiers around the world. Um, the percentage of gold is now second only to the US dollar. So we have a situation where the dollar is depreciating. Gold has overstepped this summer the euro, which was the second most held reserve. And if we look at just that change, that's a massive change. That's basically saying that gold is outperforming effectively, not actually, the economy of Europe. And so these things are not going to change. And the other reason for gold purchasing by central banks as opposed to purchasing new debt or new US debt in particular, because so much of it is just to have jurisdictional neutrality, to be able not to be under the perceived thumb of US policy, whether that's government policy, whether that's monetary policy. And a lot of that growth and that sort of tear that we talk about started in the wake of the 2022 invasion of Ukraine by Russia and the sanctions that were put upon Russia in that scenario. Now, not talking about the war itself, what those sanctions did was it made Russia say, you know what, we need to have more liquidity. We need to more access to our assets. And China said that. And the rest of the BRICS said that. And Eastern European countries said that. And they basically said, look, if there can be a sanction at any point in time against the liquidity of a nation, well, then we need to have something physical that we can move and use and value and accrete that is not going to be subject to that. And that was the other reason that gold has been pushed up. Now we throw into that what's happened in the nations themselves. For example, in China, there's been a purchasing of gold by the central bank. There has been a purchasing of gold by the state-owned banks, which connect into the central bank. There's been a purchasing of gold by the citizens of the country through their banks, up to the central bank. So there's been this whole sort of cascade of gold buying. In the West, until very recently, there's been an underperformance, for example, in gold-backed ETFs, exchange-traded funds that buy gold to physically have that anchor relative to their funds and their fund management, which just in this first half of the year, for the first time, the West has outperformed the East in terms of buying sort of exchange-traded or funded gold vehicles. And that's kicked into the current tear in the last few months. That's basically been accelerating because people are saying, look, whether we're too late or not, this train is still moving and we would like to jump on. And the fourth thing is that the managers of these funds and private wealth management groups, and from Morgan Stanley to Bank of America to Goldman Sachs to Citi, they're all increasing their gold evaluations and predictions because they're seeing, one, all of these things happening. Two, therefore, their customers being like, well, should I be in gold now? And them saying, well, you know what, if our customers want to be in gold and we're trading gold and the world's going gold, well, we need to basically promote gold as well. So it becomes a self-fulfilling sort of activity in terms of buyers.